Welcome everybody to another exciting podcast of OP Talk, and with me is
Peter.
and my name is Robert. Thank you everyone for joining us today. Off air we were going, the news out there is pretty much of the same. Trump hates Elon Musk, rhetoric. Peace between Israel and Hamas is around the corner. Macron talks to Russia for the first time. Nothing that's really exciting us out there. But I'm led to believe, Peter, you had a superannuation conference or chin-wing, or what's the word, where you had a bit of a chat with someone about.
Yeah, I just at work today. I had a chat with our super and
Yeah,
one thing that got me was the statistic that he
yeah,
gave
share,
me.
share.
Back when superannuation was first dreamed about during the Bob Hawke or Paul Keating era, one of those. I can't remember exactly which one now. What do you think? What do you think the percentage?
Yeah, the compulsory super was introduced in Australia July the 1st, 1992.
So that's during Keating then. So it might have been dreamed up during the Bob Hawke era, but never came to fruition until the Paul Keating era.
During the Hawke-Keating Labor government, specifically while the Hawke government set the stage by agreeing with the ACTU on the need for universal super.
There you go.
You're on the money here, aren't you? You really know your history there in terms of
Well,
Australian
I
politics
I I
history.
did get that reminder earlier. Now, the interesting thing about that, the GDP, when you look at,
Yeah,
I guess, the amount that the government was paying for pensions compared to the GDP, which is gross domestic product, I think it was about 4%. So it's substantial, but not substantial at the same time.
I thought the number was going to be higher off air when you asked me that question. I was
Yeah,
going for numbers I'm too even embarrassed to say because I wouldn't have thought anywhere that low. I thought it'd be a lot more straining on the Australian economy, but 4% it was. It was.
yeah. And then the interesting thing is when you compare it up to today, what the rate is, and something that shocked me was that the number dropped. So I would have thought potentially, given the aging population that we have, people living longer, um, the fact that because of those two combined elements, that even though they're super there, the number would have either stayed the same or climbed a little bit. But surprisingly, it's dropped, and it's dropped to about 1.5%, which goes to show that superannuation has had a really positive effect on funding people's retirement, which was the whole goal of the implementation of superannuation.
All right, I'm going to throw put you on the spot now. You ready? It looks like we're on a real train looking at this superannuation. Here we go. 20 ages of 25 to 29, how much super do you think men have, men and women, roughly speaking?
28 and 29, did you
Yeah,
say?
25 to 29 years of age.
25 to 29, I'd say at this point, probably about 30,000 tops.
Yeah, they're saying men 25,000 odd, women about 23,000 odd. This is from the Australian Super itself. Statistics. All right, let's jump ahead. We get closer to the finish line. What do you think the average amount a person of the age of 50 to 54 would have?
50 to 54 currently. I would say somewhere in the ballpark of 250, 300,000.
Interesting. Men average around 237,000 odd, while women average about 176,000. There you go. And then here's a bit of a scary number for you, listeners. Let's say we're getting really, really close to the finish line here. So we're getting towards 60 to 64 years of age. We can smell retirement. The birds are chirping. The air's smelling so much better. What do you think that number looks like, Peter?
This is a hard one.
All right, stop for a moment. Don't give me what you think it is. What do you think it should be?
Look, what I think it should be, like if you're going to want to live with some sort of self-funding and still relying on some pension, you probably need about $500,000.
Okay, $500,000 you're saying. Okay, let's see what it's coming up with. For a comfortable retirement in Australia, singles may need around 595,000 and a couple around 690,000. All right, keep that in mind. All right, keep that in mind. That's obviously data that's coming out from a lot of the superannuation companies out there, looking at the average age of people, how long are they going to live till, and all the rest of it. Now, I'll repeat it again for our listeners. Should have about 595,000. Let's say about 600,000.
Yeah, six. So let's round it up. Yeah, yeah.
600,000. 60 to 64, good age to retire. People might say 65. However, what do you think the number is in Australia, the average?
Lucky if they're hitting 400,000.
You are on the money because men average around 380,000 while women average short of that 300,000. So at some point, they're going to have to rely on the pension.
I will add on top of that though, something I also found out today. Even if you have a combined assets with your spouse of $1 million, that includes your super when it comes to retirement,
Yes.
and that doesn't include your principal dwelling, you have access to super. I think it goes up to 1,060,000. Yeah, if 1,060,000 combined, you still have access to the pension. I don't think it's the full pension, but you start to have access to the
Yeah,
pension.
there's ratios with that, isn't there?
Yeah.
That's right. You are correct in saying that. So the reliance on the pension is still out there. Okay. Now, interestingly, July the 2nd, you correct me if I'm wrong, the numbers have changed. What is the percentage out there now in terms of compulsory employer contribution?
Is it 12? Is it 12 and a half?
You're doing what I'm doing. You can either type in, we're going to get the number, guys. It's 12% from the 1st of July 2025. What did you say? 12 and a half.
I thought it was 12 and a half, but
You're
yeah.
pretty close.
Yeah, the government always likes their half percentages.
Mhm. So saying that 12%, okay, it's gone up, yeah?
Yes.
To a certain extent. Now, the interesting thing, most superannuation funds and schemes rely on the stock market and how the stock market works. Normally they go down during a bear market and pick up a bit of momentum during a bull market. At the moment, we're sort of who really knows, in a bullish sentimental market. Some might disagree with me and say that we're not quite in a full bear market. That's teased us a bit. There was dramatic turn in the market once Trump was elected. Obviously, he shook the markets with his tariffs around the world that he was throwing around. Markets seemed to recover as he eased a lot of that burden and fear out there, as he sort of, I don't know if he's going to agree, backtracked to a certain degree or played people, how he would look at it. The market seemed to slightly recover. And that's important because did you notice on your super balance a little bit of a spike down and then a recovery happening at the moment, Peter?
Yes, yes.
That influences people, and I want to bring that up because I can remember a good number of years ago, a work colleague of me said, whatever you do, put as much money as you can into super. That was his belief. And that's not financial advice I'm giving right now. But I can remember his plans of retirement were set back 2 years because the market had dropped at that point in time. It recovers, and it seems to be an ongoing phenomena with the markets in this day and age. E.g. COVID, markets had a real sharp drop and then seemed to recover quite beautifully. So I remember about, you correct me if I'm wrong, February, March, they had a drop and then you could see the shares pick up momentum at a rate of knots, the recovery. even though a lot of people were still working from home and businesses were still struggling. So it's quite interesting how robust the market is. Do you think the market may perhaps have more chance of recovery these days because there are so many? We'll look at superannuation as an example, relying on its success.
That definitely helps because it's you got to think in countries like Australia and America with 401ks, that's a investment that keeps happening on a regular basis and reinvestment that keeps happening on a regular basis. So when you look at it and especially in Australia, if every worker is paying into superannuation, that means there's more and more money going into that, which is not generated by the market, it's generated by um, the government forcing employers to pay for it. Naturally, the market in the long haul is always going to keep climbing, and that's always going to be a given.
It's interesting, isn't it? But there are those so called experts, and I won't mention any, that claim that we're just around the corner from the next major stock market crash. I find that really intriguing at times. What I worry about when you look at the stock market at a protracted or long term outlook, zoom out, so to speak, you sometimes think, okay, if I'm about 60, 65, I'm getting ready to retire. If the stock market crashes dramatically and takes a good 10, 15 years to recover, where does that put me? Because I'm going to be 80 before the market recovers to a point of being able to enjoy that lovely nest egg superannuation you have, which obviously you want to be accessing from 65, 67 onwards.
You know what's interesting though? Like when you look at like what would you say has been the biggest, I guess, downturn in stock market history?
I always think of the Great Depression.
Not counting the Great Depression, by the way, because that was a pretty bad time. But after the Great Depression, so from the Second World War onwards, when would you say would have been a bad time for like markets and the stock markets dropping and the market being in a lull?
I don't know. I should know this and I don't. And I always think of the 70s being a bad time. This is some vibe about the 1970s.
Yeah, well, the
I don't
70s were
know.
a bad time because of the oil crisis.
Yeah, that's why I start thinking that way. And in fact, historically, it says in the 694 days between the 11th of January 73 and the 6th of December 74, New York Stock Exchange Dow Industrial Average benchmark suffered the seventh worst bear market in its history, losing over 45% of its value.
Yeah,
There's a
but
number for
how
you.
long did it take to recover after that?
That's so true. And it made me pause for a moment as I read that because 11th of January 73, 6th of December 74, benchmark suffered the seventh worst. And then the recovery, I don't know, when was it? When did it recover? How long did it take before it recovered? There goes my mic for a moment.
And that's just to recover the losses.
It took a considerable amount of time to recover. While the market began to recover in the early 80s, it did not fully recover to its pre-crash levels until the early 1990s. Does that scare you?
Yeah.
Well, you're 65. Your golden years of retirement are going to be then. You know, you're 67. They're your golden years for the next 10 years. You haven't got that time to wait a good
Yeah,
20
but
years.
the thing is that's back then. Now, looking at if you look at like the financial crisis that happened during 2008,
Yeah, that was a major one. We do know that. That was the whole property and banks in America, wasn't it?
yeah,
Scenario
and I'm just
shenanigans.
and I'm just looking at the Dow Jones Industrial Average when I'm looking at this and like plotting the numbers. It took about 2.5 to 3 years for it to recover what it lost. This is on the Dow Jones again, as I said,
Yeah.
right? So what's scary about it, what scares me is the volatility because when you look at it took a considerable amount of years. Now, the next, I guess, really big incident that happened was the financial crisis in 2008, and that was only a 3-year recovery until it reached the same levels that it was before that.
Yeah, but I would argue, do we then say that that was a slight blemish in the market as opposed to the 70s when it was a true multifaceted collapse and lack of confidence in the market? Now, all it takes is a nice big war or some major world event to get us bogged down for a good decade or two.
Yeah, well, I guess the political climate was a lot different during the Cold War and everything like that.
Yeah, 70s wasn't a very positive outlook of a decade, was it? The 70s?
Yeah, but now let's go even scarier, right? So during the COVID pandemic, right? That was that. By the way, that was a bigger drop in the Dow Jones than what the 2008 financial crisis was.
Yeah, yeah,
All right, in terms of value that's been taken off the market, and much bigger. I'd say probably double the
yeah.
amount. And it took less than a year for it to recover to where it was before the
I
crash.
found that quite phenomenal, that recovery, to be quite honest. And I'd find it incredibly intriguing given that a lot of businesses and companies and workplaces were struggling. But then governments did roll up their sleeves and try to stimulate the economy. We know in Australia they certainly did that, didn't they? They had,
Yeah, there's a lot of stimulus package
yeah,
for. Right, I'd say it probably lost a quarter of its value at the time, which like is quite considerable. Like so the amount that happened beforehand obviously was more, but the percentage probably wasn't as high. But I'm looking at like money amounts, right? Because when you see like the dip and it climbing back up, so are you surprised after you like see it fall so much and then climb so rapidly? Like why things like houses are now double the price that it was before the COVID pandemic, food prices going up, goods and services going up, labor prices going up. Like, does that surprise you, or do you think it's like that incident that happened there kicked off that kind of that devaluation, I guess, of some currencies around the world?
I worry about, to be quite honest, the manipulation possibly in the market to keep it looking a lot more positive than what it actually is. And it's been disguised the fact that we are in a point of no return and still in a dip, that we're living it out right now. We don't realize it, and in any day it could really drop down again. That's been stimulated and possibly a narrative sold to keep that market looking a lot better than what it is. I worry about that. There
Yeah.
are experts out there that do claim, but you got to be careful for experts because some of these experts they've been crying for 20 years that we're about to go into the end of times, collapse of the market.
You know what I always think when it comes to the market and stuff. Like there's going to be devaluation, there's going to be deflation, inflation, everything in between. But like when you think back to what happened with some of our big civilizations, so the Persian Empire, the Roman Empire, the British Empire.
Yeah,
What are the empires? The Greek
Ottoman,
Empire.
Ottoman. Did you mention Ottoman Empire?
Yeah, the Ottoman Empire, they
Yeah,
didn't crash and burn. Like it wasn't one event that
yeah, we,
it, it
yeah.
yeah, like if you look at the Roman Empire, I like the Roman Empire because it was such a gradual decline.
Yeah, we
That
almost sometimes think that it was the great fires of Rome,
yeah,
but it
but
wasn't quite that, was
it
it?
wasn't like
No.
Rome persisted up until like the 1400s or
Mm.
even longer when the capital city was taken over by the Ottomans. So it's existed for, but declined in such a long time, and I think kind of that's what's happening now. We're in this decline period as a civilized people. So as a species and people, we're in a decline. While we might have times of good, and we might still have a lot of plentiful things that if you're fortunate enough to be born in the right place in the world, but we're in that decline period.
Yeah, and the problem with that is like if you look at what you're saying, the Great Depression itself,
Yeah.
which is sometimes referred to the crash that was incredible, took 25 years to get back to its previous high, the S&P 500.
You know what started the Great Depression crash?
Led to occurred when the post World War One economic boom, which led to overconfidence, overspending, and overinflation of prices.
Yeah, so what was happening is that's when they allowed investment into I think it was futures, particularly like the one that was caused the issue. I think it was the grain futures. So basically, what that does, it allows you to kind of um, I guess invest into, say, grain, because for 1 year coming up that you're going to have to sell a certain amount, but you invest into it beforehand so you can sell it at a higher price when it comes in demand. But you don't actually hold anything. You're putting the investment in so they can get the tools to harvest it, get it out, and sell it. So you're spurring that type of economic growth. But
So overconfidence, overspending,
yeah,
and
so
the
what
overall
happened?
inflation of prices.
Yeah, and then the double-edged sword was they allowed margin borrowing to take place, right? So you could essentially borrow on margin to get these futures, and then when what happened during what kicked off the Great Depression, what they say is the margins started to be called in for all these people that took out those loans. And with margin loans, you have a certain period to pay them off. It's not a 30-year loan, yeah, with X amount of interest, whatever. It's you have to pay it on a certain date once it's called in. And if you don't pay it, you default and you're bankrupt, or you have to actually physically come up with the money. Anyways, so when they couldn't when they couldn't pay for it, not naturally the dominoes fell and everything kind of collapsed down on itself.
It's interesting, but there were some winners in this because there were investors that did buy at the bottom,
Yes, yes, and the same thing goes with every single one since then. People bought at the bottom.
especially if you don't overextend yourself with risky loans.
Yeah, and I think
Yeah.
I think that's been the advice. If you look at all the major ones in the last a century and a half, all the major issues that have happened is overextension when it comes to loans.
I guess it all balances out. If you're buying consistently as the market fluctuates up and down, you want to believe at some point you're going to obviously come out relatively on top to a certain extent. Obviously, in the mix of it all is if you are investing directly in shares, there is the aspect of gaining dividends and dividend reinvestments that can be beneficial in building your portfolio. But looking at superannuation, you are relying on the wonders of compound interest. It's an interesting way of looking at the mathematics because it's interest on what you have, but at the same time, simultaneously, you're continuously contributing. I think the law in Australia is about to change where employees can't wait a month to contribute. I think they have to contribute more frequently.
I think it's every pay now.
Yeah, that's what's changing, isn't it? I think
Yeah,
that's
or every 2 weeks. It's like
yeah,
it's
fortnightly. Yeah,
yeah, because I think before it was once a quarter or something
I thought it was
like that.
monthly. Oh,
Yeah.
maybe dependent on employers. Not sure. It'll be interesting for our listeners to tell us that. That's really interesting in all of this picture. But I feel sometimes when you have super, you don't have control of it. You're a sitting duck because, as I said, the winners during the Great Depression were those that were ready to snap up, I guess, the bargains as the market fell. When do you make your money? When fear is around in the market, I guess. Money's made during bear markets.
Yeah, exactly. They're the times you really want to have liquid assets, not so much. And by liquid, I mean monetary assets that you can spend on acquiring cheaper assets that have dropped in value.
I'm interested in terms of the superannuation in Australia, what the drops and dips, how they've worked in terms of on a graph of some sort. I'd love to see a graph. Have you ever seen a graph of it?
Not for superannuation.
Does it correlate? Because I'd be interesting to know. Does it correlate or connect to the stock market directly? Is there a direct connection? If that makes sense.
Well, see, with
Obviously, there's a slight one, but
yeah, the interesting thing is the superannuation companies, they have their own team of brokers that
that's right.
handle the investments, and it's up to them to make sure that there's growth on the accounts. So they get to choose how they invest the whole portfolio or portfolios for people, right? So depending on how many people are, it's divvied up in a certain way, how good you are, blah, blah, blah. And um, the scary part about that is most people don't understand that they do have some influence depending on your superannuation provider. That
Yeah, you can put more
because you
risk.
can optimize for like a share only investment strategy, interest only investment strategy. Granted, it means if you the more risk you take, the more reward potentially you can have. But with greater risk comes a chance of losing as well. But then on the flip side, if you play it safe, there's very low chance of losing anything, but you don't acquire that passive kind of interest style of sorry, the compounding
Yeah, but
style of
they do use the school of thought. Often superannuation advises that as you get closer to that, smelling that sea breeze of retirement, you then adjust your levels of excuse me, of how you invest by changing from an aggressive investment portfolio to a more conservative one as you get towards, for instance, it could be 58 to 65. You start to wind it back, and as you pointed out, because you can change it throughout your journey with superannuation. But what I also find interesting, I did look at a graph to compare superannuation versus the ASX, and it correlates amazingly close, very close. When we talk about COVID drop, superannuation funds around the country did drop, whether you like it or not. So,
Yeah, and that even made me think as well. Some workers who dipped into their super during those drop periods. So they kind of so if they took say 10,000 out, potentially at this point they would have taken 15, if maybe close to 20,000 out because of how the market's changed since then.
is there an asset outside of shares that decouples itself from the ASX? You would argue
Yeah, housing.
property, isn't it? Property
Yeah,
is your big winner
yeah. Well, if you
in
look
that
at
sense.
it, yeah, like I think when it comes to especially Australian property, I don't think there's ever been a year where there's been drops of double digits, um,
Mm.
where there's been, but in some years there's been climbs of double digits.
Yeah, that's interesting, isn't it? Obviously, you can't include your own house that you live in when we say this because that you need a roof over your head, don't you? So it's not necessarily the asset that, or your part of your nest egg, if you want to call it, of retirement in many ways. So you have to consider several properties possibly as an
Yeah.
approach.
One of the interesting things that, in terms of my listening of like podcasts and people like on YouTube, things like that, one of the interesting things I kind of heard on one of those, and all this is, none of this is financial advice, it's just us talking, is that if you self manage your super, all right, especially at the start, this is like if I was young, this is probably what I would do, but keep in mind again, no, this is not financial advice, is I would start a self-managed super fund and put extra into my self-managed super fund and buy an investment property, and by that I mean land. So it takes a lot to get started, but once it's kicked off, essentially you've got a property portfolio that you use for your retirement, that you can link into whenever you want. Yeah, and if you look at the last 10 years, property prices have doubled.
Interesting, isn't it?
Yeah.
Interesting in terms of the property as a comparison to other assets. There are those that consider crypto or gold and silver as options as well. But the gold seems to be connected. I'm looking at a graph right now. There was a little bit of a peak there where it did do considerably better than the stock market, but overall it has actually
No,
outperformed.
overall it always will. And
Yeah,
one of the things I learned when it comes to gold, it's a store of wealth. So it's not good. It's not but by that I mean, if you go back to the 1900s, right, an ounce of gold would have bought you a really nice like suit at that time, right? And this, I mean, tailor made, using nice materials for the time. Like this is something that's really nice. It's about the same today. right? When you consider the prices. So if you invested in gold back then and stored it up until now, you would essentially have the same value when it comes to exchanging for goods and services.
That's interesting, isn't it?
Yeah, yeah, and like
Very interesting connection, looking
yeah,
at
so
a
so
historical perspective.
yeah, and what I do then is, if you want to see how things are really panning out, I guess in the world, is you get the gold graph and stick it up against any asset that you want to invest into, right? And if the asset that you're investing looks better than the gold in terms of the graph, how it's projecting, that's you invested in a good asset. Now, if it's not so much, you take that risk. Is it going to take off? Is it not? Things like that.
Of course, with property presents its own challenges, doesn't it? Especially when you talk about investing in properties. The return sometimes it does require work to get that little bit of return. As you obviously as you accumulate more properties, you're going to see that meaty contribution to your wallet. But each property you have presents its challenges in terms of obviously you're going to be wanting to rent it out and getting an income out of it. But then what comes out of that, of course, is tax. Don't ever forget that because it's added to your pay. But not only that, you still come out on in front, I would argue, but then you have to have it rented and then you have to rely on that the property doesn't require maintenance. But of course, you can claim to a certain degree. What's the amount you can actually claim with maintenance on a property?
However much you want.
So the full amount, in
So,
essence.
so say for example, if you needed to, let's just say for argument's sake, your house started sinking the foundation, and you
Mm.
didn't have home insurance, and you needed to pay for maintenance to lift the foundations. That is classed as a maintenance deductible that you can put on your tax return.
Interesting, isn't it? Yeah. So the whole amount, whole
Yeah,
kit and
the whole,
caboodle.
the whole kit and caboodle is claimed as your negative,
Yeah.
like your taxable from your taxable income, right? And the interesting thing though, right? And this is now, like you said, in terms of the tax side and stuff. Now, if you're starting out and you go hard on your super, like, and I mean self-managed super, you can buy an investment property, right, through your super, rent it out. Any income that you make off it doesn't get taxed because it's your super. So there's no income tax on it. Granted, though, any deductions you can't claim because it's a separate entity again from your actual income. So that's, I guess, the negative. But if you find the right investment place or investment house or asset, however you want, whatever it is in the housing market, you're actually in a positive position, right, where you can start jumping to the next ship and moving along and getting more and more properties. Where if I started that when I started working,
Mm.
let me just take a guess, I'll probably be sitting at probably about 2 million. That's if I started, and that's without investing like crazy, but putting enough in where I can make sure that it has the right start that it needs to get everything kicked off.
Now the government's looking at if you have more than $3 million taxing you. Do you see that as an issue?
Not now.
But it will be for next generations because of inflation and what they'll end up having in the bank balance after, well, when they get to 65, 67, it could be 70 by then when they can access their super. It'll be interesting to see because a lot of them, if you do your maths, will have just in super alone, not self-funded or any clever way of managing your money, just your employer's contributions, which will continue to increase. Inflation will continue to increase, pays will continue to increase. You're going to end up hitting that $3 million mark
Well, I'll give
easily.
you some context. So, and this will give our listeners some context. All right, in 1970, the average wage was $4,196 per year.
Mm,
Right
yes.
now, fast forward 50 years, right,
Mm,
and we all know that people are going to work more than 50 years. But fast
yes.
forward 50 years,
Yes.
the average wage is sitting at like $90,000.
Yes. How much super are you going to have in there if you match those numbers?
Yeah, so if we have the same level of inflation where the value of money decreases by another tenfold,
15, 18 times.
yes, exactly.
It's a lot.
Yeah, yeah. It's quite yeah, people are going to be reaching that limit before they even retire. These are people starting to work right now, way before they retire. Probably when they're in their 40s, they'll probably be sitting on that 40 million. Sorry, so 40 million on that 3 million threshold or very close to it.
Are you a big fan in contributing more to super or just letting the employer contribution go in?
Like I said, now I just do the employer contributions and leave it. Like I never knew about super at the time, and that's what I did. If I was
Now?
starting
Yeah,
fresh,
that's what we're talking
yeah,
about.
starting fresh, I would do a self-managed super.
Wow, self-managed. Yeah,
Yeah,
okay. You've said that
self-managed
a few times.
and contribute from my own income into it as well because you can get there's so much benefits in making those contributions and essentially start off so if I was starting now, I'll try and build as much wealth as I can by investing it into the stock market to gain enough traction to where I have enough for a deposit or whatever I can get to use that super account to buy a property. And this is something I would speak to financial advisors and stuff and
Yeah,
get
of
the right
course.
advice for it.
You have to
Um,
pay for that part, of course,
yeah, of
for our
course you got
listeners to know.
and you got to contribute as well. Like so your weekly income, like is reduced because of that. Because you're managing your own super, right? That's 12% now, like coming July, of extra income that you're deciding where it goes, and you can choose to invest it for your future. You make the choice, right? Whereas when you're investing it through a superannuation company, that's great. They're going to give you a safe return, but if you look at the last 10 years, has our super accounts doubled in value? No, they haven't. House prices have though. So if you're managing your own super, you decide where you invest
Mm.
into to try and maximize your profits from the other side.
So you're a big fan of property investment, pretty much?
Yeah, yeah, I definitely am. Like, I look, I wouldn't do it with income like that I earned from a 9 to 5 job. I would be doing it with superannuation, or if I was doing it with my own income, I wouldn't do it through like personal means. I would be setting up businesses like a trust, a family trust or something, and then start going down that path that way.
How about this in ChatGPT? Property versus shares performance in the last 10 years. You want to find out what it says, what it spits out in
Well,
Australia, yeah?
yeah, yeah.
Okay. All right, who's the winner? Who is the winner? Okay, you're thinking it's going to be property? Yeah. Waiting for the response. It's going to be interesting. Property over the last decade, Australian properties has generally delivered annualised returns of around 7 to 8%, with peaks in some years when demand and prices surged. ASX 200 has provided annualised returns of around 8 to 9% over the past decade. Key takeaway summary: property good overall growth, strong long term performance, but more volatile is the shares. So, property can deliver about the same. Can I argue that?
Yeah.
But that's if shares are, like he says, it can be volatile and you don't know. This is based on the past 10 years, but if you're looking at if we're in a massive lull, where are you going to be sitting at then? Would shares work if you just consistently keep putting into them, not worrying about the ups and downs, Peter?
If I was,
Possibly.
if I like, I would start off in share investment. The reason being, it is a good way to earn steady income if you invest like in a safe kind of way, like where. But that's how it'd be like that. That's the kickoff. But I'll then shift it over to housing, just
Mm.
because it is like, say for example, if you were to pass away, for example, and your wife needed to pay off like the house like that you're paying off while working, your super can cover that because that the super asset can be sold off. She can then withdraw all the money from the super, pay tax, but then pay off the mortgage, right? You've got that kind of coverage there. That's using the self-managed model anyways. Whereas in shares, it might be a bad time to do that. So then
Mm.
there's potential risks in doing it that way.
Very interesting. And I looked at also, what if we just keep the money in the bank? Or you could always look at keeping your money under the bed, but the problem is inflation. your dollar today is going to be worth a lot less tomorrow. So, and if you look at that return you get from a bank these days, you'll be lucky to get 4% almost, to be quite honest. There are fixed accounts. And remember, you are only guaranteed in a bank account in Australia where they will cover you if something was to happen to the banks. That doesn't happen often, by the way, but if it was to happen, the government will cover you for up to 250,000 or 500,000 for a couple. And believe you me, I've spoken to banks, and some banks don't even know that last bit I spoke about, where it's 500,000 per couple, where you're protected if something happens to the bank. And remember, you're only getting a return of 3 to 5%. You'll be
And
lucky
look,
to get that.
that's not a terrible return.
No, it's a safe option,
Yeah,
you would
yeah,
argue.
yeah. It's a safe option, and it's not terrible. But yeah, you know what? Like you said earlier, it's an option for when you are looking for retirement. So you've got your figure. Let's just say your super account has earned $1 million, and you're like, okay, that was my mark. I needed that 1 million. Now I've hit it. I am going to now
Yeah,
maybe work for another year because I still feel like I want to
yeah,
work.
yes.
Withdraw out now that I have it, put it in a bank account, and let it start earning interest on that, and I can have a safe return type of thing.
What about crypto?
Too volatile.
Yeah.
When is something like Bitcoin going to happen again? Like, where you buy it in 2010 for nothing, and then it goes up to 30,000.
I think Bitcoin will go up, but I don't think it's going to have the glory of what it's had in the past. It is recognized now as an asset, possibility to have as a wealth creation, Bitcoin itself, but there is a lot of junk out there. When we talk about crypto,
We got
meme
all the meme
coins,
coins and
yeah,
everything.
that's right, and they are volatile. They're real pump and dump schemes.
Yeah, yeah. And you could see like Elon Musk partook in some of these pump
Yeah.
and dumps. I'm pretty sure even Donald Trump might have done
Yeah,
the
the
same
Trump
thing.
coin just before
Yeah.
his inauguration. How did
Yeah,
that?
there you
How did
go.
that? Go figure that one. That one there. Go figure that one. He talks about the swamp and draining the swamp and all the bad shonky stuff that goes on. And there he is, his son. I'm sure it's his son involved in it, where they release a coin or a part of that venture to release a coin, and it was a literal pump and dump. It's a tenth of its price when it was doing quite well. To give you an idea for our listeners.
Yeah. It's no, it's the old adage there of your scum. Sorry, doing that is scum unless you're me. All right.
Yeah, yeah, he's becoming more and more like that. And like we said, news is a bit boring at the moment. But Trump will always. We could spend every episode just following Trump. Seriously, with
Yeah,
his
yeah.
dramas.
And look, even we try to avoid it, and we're still talking about him.
It's hard not to be because he's having some fun with Elon Musk at the moment, because obviously Elon Musk thought he was going to get an easy ride with Trump, and Trump's turned around and said, I've always hated EV cars, for those that have been following the news. And he's saying, no, I'm not going to be giving you government subsidies that you're expecting. I'm not a fan of it. He's always, but it's funny because he's always said drill, drill, drill. He loves oil. So I don't know what Elon Musk was thinking. So I don't. You know what? With Trump in general, do you think he has friends for life, or do people come and go in his life? It seems to be that trend or pattern.
Nah, look, I would say people come and go. But think about, to give him a bit of slack. Think of, like, pull back and just think of normal people. How many true friends do you have? And you don't have to say anything, but just think about it. How many true friends do you have? Right? And how many people kind of come and go into your life? And that's not a bad thing that people come and go into your life. I think that's
Yeah,
actually
but
a good thing.
I'm looking at it more like they come and go, and it's not left in a very nice way. There's always collateral damage with Trump when someone leaves, or all of a sudden is no longer flavour of the month, so to speak, for him. It ends up becoming a real case of a few words exchanged. We're seeing that played out in a really big dramatised sense with Elon Musk at the moment.
Yeah, but you know as well though, like I think with any friendship, Like when I guess the friendship like wanes a little bit. There's always it's like a relationship. Well, it is a relationship, but in a different way. But it's like a relationship like where people are intimate. And someone breaks the trust or does something to hurt the other person, they're going to feel pain about it. So there's going to be one person that
Mm.
feels pain, and the other person has no idea that they inflicted that much pain.
And of course, Trump is going to make it public when he does, and
That's
all the
correct.
other parties, not just him, are going to make it be known how he's feeling or
Yeah,
they are
exactly,
feeling at the
exactly.
time.
Yeah, exactly. He doesn't hold back, so
Yes.
he makes it known. So he's basically just airing what happens to everyone, but he's making it public, and as making and because he's a public figure, you know, the whole the whole world knows about it.
So true. So true. Indeed. It's been a great episode. We're not financial advisors. We just gave our, it's nice to, sometimes I get frustrated when people say, I'm not a financial advisor. I'm going to tell you what to do. And then they don't tell you what to do. They just talk. I'm off for 4 good hours, 2 hours, and they go, there's this option, this option, this option. I really appreciate Peter being able to ask you directly what you would do to your younger self. I would, believe it or not, because I haven't answered the question. I've dabbled with the idea, and I think I've told you this before, if I was younger, to invest in, say, an ETF. And obviously, for those that don't know, an ETF is a nice big parcel of a variety of shares. Pretty much where you're going to a stockbroker and they'll select what we call blue chip shares. So in Australia, a good example is the Vanguard shares. As an example, and they have a variety of products. There's even ones that invest inclined towards property, and there are those that are just nestled investing in blue chip shares, e.g., West Farmers and a variety of BHP and a variety of others. So the key is if you start young and you do it consistently enough, I could see benefit that way. I cannot lie. I like the idea of property, but you have to start somewhere. And I think some young people don't realize that if they're living at home, this is a bit of advicey, but this is advice. If you're living at home, rather than your gym membership and all your other memberships, I'm not saying not to have that, by the way. So you should have a bit of a downtime and that. But think carefully, be a bit more frugal with your money, and you could get yourself a nice little studio apartment even to start with. You're still living at home, a studio apartment that you rent out and start building that, as you pointed out, Peter, a portfolio of some sort. And before you might, by the age of 30, own 2 or 3 properties, then you start thinking about moving away from home, getting yourself a nice, decent for a property or a house that you're going to live in or a unit you're going to live in the same at the same time you have all these other little properties that are earning possibly when you're in your 40s money for you, and as part of your retirement you might then sell them and have made your money. So we're talking about you will hold on to them for a good 30, 40 years. Peter, what do you reckon of that strategy?
Yeah, and based on the numbers that you pulled earlier, that is completely viable. One thing I was doing while you were talking as well, I was listening at one, but number two, I was just having a look at minimum wage, right, in Australia,
Yes.
right?
Yes.
And the reason why I bring up minimum wage is because it's a good way to kind of see where I guess the wage is at, like for adults, the minimum that they can earn here, right? So the minimum is about $50,000 a year before tax, right? So if you take out tax, let's say for argument's sake, and this is just rough numbers. I'm sure it's going to be more than this, but let's just say rough. After tax, you have $40,000 every year, right? Um, Keep in mind, this is generally wages that people will be starting on, like they wouldn't be stuck on that wage for a long time. But let's just say this, you're starting off, you're living at home, $40,000 a year, right? So if you divide that by 52, that's about, let's say, $750 a week. All right. Um, Out of that, if you cannot save, um, if you cannot save $250 a week from that to use for like investments or put extra in your superannuation Like these are things that we're both talking about, like in our kind of strategies if we were young again. That's when you got to think, what are you actually doing if you're living at home? Different story. If you're living on your own, like because your circumstances don't allow you to live at home, yeah, you're in a tough spot. You can't afford much. But living at home, that's $1,000 a month. You should be able to be put away into an investor into somewhere.
Come on, young people, do something about it. I agree with you there, Peter.
But even better, I think you could put more. You know,
Yeah.
250 is reasonable while still having, I guess, a life as well. Because you gotta, when you're young, that's a chance where you gotta meet your future your future wife or husband. And you got to have fun with them. It can't be all just work, work, work. But you still got to make sure you're planning your future at the same time as well.
That's really, really interesting way of looking at it in a way for young people to I do hear them complain a lot about that it is more difficult, and it is, and we've done the ratio numbers, we're not disputing that, but there are ways you can start off small. Could be a one-bedroom unit, it could be a studio apartment. Obviously, you got to do your research and you got to be careful where you buy. You want it somewhere where it's rentable and all the rest of it, but there are places out there where it is achievable. Something of 400,000 where you save up enough for a deposit. Might be difficult for a few years, get it close to about a $70,000-$80,000 deposit, and you're on your way, Peter.
Yeah, definitely. And especially like I guess when it comes to the property side of things as well, investing now, like so using now, we can't talk about the past or if I was to do it over again. So looking at it now, the only time I would invest into a unit, for example, would be is if I'm living in that unit and potentially have housemates. Um, I would try to get land if you can. So a house that has land, whether it's those units where you have two or three where you pay
Yeah,
strata, that's a little bit
yeah.
better than an actual unit, like a flat type unit. And the reason why I say that is just because the value you get more return from it, like when you go to sell, because you gotta remember whatever mortgage you put on it, if you stick out the 30 years, for argument's sake, you're close to paying double the value of the unit. Now, unless you sell at the end of it for double the value, right, you're still going to pay capital gains tax. Sorry. Yeah, if it's not your primary residence, you're still going to pay capital gains tax on it, so you end up losing, right, in the long run. So you got to be careful on what you start out with. Like I said, units are great investments when you're starting out today, but in the past they were actually really good investments to get into from the ground up. It's just that, yeah, today I find because there's so many going up, like if you look at places like Liverpool, Parramatta, and this is in Sydney, the prices are very stagnant, or some of them even fall after a few years. Even Ryan, Macquarie Park, all those places up there, I've heard stories where prices have not moved or dropped since people have purchased, and they're stuck into what they've purchased.
That's a concern. You do have to do your research. There's a lot involved, isn't there,
Yeah.
in all of this? It's not as easy as it used to be. What a great episode. Hopefully, it's been a good episode to give people a little bit more insight into the way money functions. Yes, we work to live, not what is it? Work.
Yeah,
We
we work
work,
to live, not live to work.
not live to work. We do not, Peter, want to be living to work. But at the same time, you have to find ways of setting up your future, and possibly something's difficult when you're young. Isn't it funny to be both saying, if we only we were younger, we would have done X, Y, Z, whatever it be. But
Yeah, and I guess I'm kind of just a bit
oh,
disappointed that I never received like direct advice.
yeah, yeah. I wish I knew more about how the way shares and stuff function.
Yeah, yeah. I think that we should probably try a couple more topics targeted towards certain aspects on what we would do with obviously a certain level of safety in it as well. But obviously, there's risks in everything that you do, though.
Yeah, that's right.
Yeah.
Well, anyway, my name is Robert, and with me is